show. It is your Tuesday afternoon, a retail sales kind of day. Hello, Tom, and we got Chris. Good to see you out there, Chris. Terry, Katut, Ron, he made a live show. I'm happy you joined us for the live ones. More interaction that way, makes it more fun. Giselle as well. Giselle, you're double dipping today. You get me in this one, and then you get the CIL this evening, which should be fun as well. Alex, good to see you, my friend. Big Eb, Les Gold, and of course, David Rostrakar. And Boss Poopa says, Mount Gay rum today. I still not drinking. Beer will be, the first beer in over 2 weeks will happen this Thursday at Trivia, but that's pretty much it. And hello, Kenny. Good to see you with us as well. Siraj. Okay, so today's show, I know we've talked about moving averages in the past, and for some of you, it might be like, oh, here we go with the basic, stupid, boring stuff. I'm not going to make the whole show about moving averages by any means, but I do have my opinions on ways to use them, and I figure I may as well share that with a couple of people who've sent in comments and questions about moving averages. We'll talk about retail sales as well, so a whole bunch of stuff to talk about today. So let me start things off with maybe just fixing my graphics package here and getting that piece so we can finally read the whole screen. How about that? It's a little bit better. Best way to use moving averages. Now, this all stems from, over the past week, I've had 2 questions on moving averages. Actually, I think there was a third one, but I decided to just post the 2 here. So let me show you these 2, and then we'll go back to the economic announcements. Lee says, do you have a preferred moving average period you use? If so, how and why? And then from Karen says, what's the best way to use moving averages? Which, of course, is the topic for the show. So I'll start off with Lee's question, which is, yeah, it'll be me. It's all right, Boss Poopa. You can be mean. That's not being mean anyway. Don't have to drink to have a good time, right? Wasn't that like some 80s pop song? We don't have to have a... Anyway. As far as moving averages goes, I probably need to explain what they are, how they function a little bit for some people who might be new. But bottom line is I don't have a preferred one, right? When I look at moving average, it's designed to do really one thing. And that's to tell you what the average price has looked like over a defined period of time. So let me go back to my horrible artwork, and hopefully I threw this together last second, but I will do my best to make it look good. This is not an earnings calendar because I was literally building this up to the second we started the show. So let's just say moving averages. We will say these are 2 different types of moving averages. This is going to be a simple moving average versus an exponential moving average, right? So there's 2 real basic types. The first one is on the left-hand side of your screen, which is a simple moving average. Now, what I'm showing you here is, let's assume that this is a daily candle, right? So every candle you see on the screen is a daily candle, meaning it represents a full trading day of activity. Now, that could be futures, Forex, it could be cryptocurrency. There still is technically a day beginning and end. So both of these charts are identical. On the left, I'm looking at a simple moving average. And what that does is it takes the closing price of every one of these bars. So you can see everyone's like, it's a candlestick chart, but takes the closing price of every candle, adds those all together, and then divides by 20, if it's a 20-period moving average, right? So all that's designed to do is say, what is the average price over the last 20 bars? Now, I'm using daily because that's normally where I use my moving averages. But this could be a 5-minute chart, and you'd be using 25-minute bars. Therefore, you have a 100-minute worth of time traded. What the simple moving average does is it now plots that line. It says, okay, if I go from this hard red edge right here, let me get my pen out for you, right where I'm putting this little red circle or dot or whatever the hell that object is, that is taking the last 20 candles closes and dividing by 20. That's all this is doing. So in practice, you look at the simple moving average here, and it's saying, all right, we know right now that price is trending upward. Now, the moving average tells you that because it has been sloping upward. However, if you have a decent set of eyeballs, you can just look at the price chart and you can see there that it's been moving up as well. So in that sense, it doesn't help you too much. What's noteworthy here when we look at an SMA, which is simple moving average on the left, and I'll show you an EMA on the right in a second, is a simple moving average gives every one of the closes from each of these 20 candles the same weighting. It doesn't give preferential treatment to any one of those. That's important because I predominantly, there you go. Thanks, Jeff. I'm definitely not taking my clothes off, but I thought there was one song that's like you didn't have to drink to have a good time or something like that. Maybe that's what my high school professors or high school teachers were teaching me. So they're all evenly weighted. So this little guy right here, I'm circling in red, this tiny little candle, it was nice, a little bit of a green one, slight up, but it really didn't do much that day. That closing price right here at the top has the same merit, the same value, and the same weighting as any of these other ones. And you can see those by the bars at the bottom. The bars at the bottom kind of tell you where it's weighting the data. Now here's where things get different. If you look on the right-hand side, we have an exponential moving average, which takes the same 20 bars of data, right? It takes the same 20 closes. But what it does is this one way back here, draw a little arrow to it, okay, this one here, it basically says, yeah, we know you closed down here at the bottom of this candle, but it's not really strong. So it's so old, we're going to give it just a small little weighting. So it's diminishing the historical stuff. Now, why is this important? Well, it boils down to what is your trading style. So as someone who's a longer term investor, or even I would say a swing trader, personally I think simple moving averages are the way to go. And the reason for that is more people are using a simple moving average. When you open up a trading platform, Thinkorswim, TradeStation, TastyWorks, CliK, it doesn't matter which one you pick. Generally, it opens to one of 3 time frames, a 20, a 40, or a 50 period. That's the normal default. 20 is probably the most common standard default on a platform when you install a moving average. So if we install a moving average and we don't know what they are, how they're constructed, but we want to use it for trades, then most people around the world are using the defaults. So that's one of the main reasons why I prefer simple moving averages. That said, they can be lagging because if you're a short-term trader, right? Let's say you're a day trader and you really want to be responsive to the most recent prices, an exponential moving average is going to give you a better price tracking. So look here. And I actually drew these in by hand. They're pretty close to accurate, but notice what the moving average line looks like on the right side. You can see it's much more responsive. You can see that when this big candle took off, it curved much more quickly, much more aggressive. Now they're both telling you basically the same thing, but because the one on the right-hand side is much more responsive, meaning it has more value, it gives more merit to this candle on the how do I draw these? Because I'm just doing a horrible artwork here. Let me see if I can erase things. Todd Davis likes to say recency equals relevancy. Correct. You know, and I think as someone who's more active, that's actually a pretty good way to look at it, right? So, for example, I'll put a 20 over here. This is the 20th candle in the sequence, meaning it's the oldest one, and this is the most recent one. Well, this number 1 candle on the hard red edge has a lot more weight. It's much more valid, relevancy, as GD put in the chat. So, you know, this is really a matter of personal preference. If I'm short-term trading, I actually do like to use the exponentials just because I need to be much more responsive to what's going on with price right now. And do I care really what happened 20 bars ago? I do, but it's not as critical as what's happening right now because I'm trading the right now. I'm trading this hard right edge here on an exponential. So I think it's important to know the difference between an SMA and an EMA, which is a simple moving average, and an exponential moving average. There are other types, but now you're kind of getting a little bit exotic out there with the moving averages. So now the question, which obviously comes up, is, well, which one do you like? What time frame do you like? Which one's the best? I think Karen said, what's the best way to use them? And Lee was asking, which period do I like best? I really only look at 3 periods. I look at the 20, I look at the 50, and I look at the 200. Those are pretty much it. Now, I know many of you, maybe you've taken a class with Brandon Wendell, or you've got so many different other instructors at Online Trading Academy that are all using maybe some slight variation or some crossover system. That's all fine and dandy. My bottom line here with any technical indicator, and as we go through here, let me show you what we have available in TradingView, and I can show you in TradeStation as well, because I think TradeStation has more. But you guys look here, these are all technical indicators. All of these. Shaken oscillators, the envelopes, MACDs, McGideons, on-balance volume. You've got Rob Booker's intraday pivots, the Knoxville divergence, the reversal, the Ziv ghost pivots. I mean, it's kind of crazy how many stupid names there are. And this isn't even all of them. This guy here, down here, Woody CCI. If you want to talk about the Jonestown kind of craziness where people just drinking the Kool-Aid, this guy, Dr. Woody, I don't even think he's a doctor, but I used to see him at the trade shows all the time, and man, he has fanatics that believe that this is the goose that lays the golden egg. If you follow Woody CCI, you're guaranteed to make 100x in your money in a month, that type of horrible salesmanship. But anyway, there's people who believe that every single indicator is the best thing in the world, and I do not. I believe every indicator is used to be a crutch. It's a decision support system. You really do not rely on these. And for example, we are here on TradingView, right? I mean, if I look at this price chart, and this is the S&P, I don't need to put a moving average on here. I know what a 20 is going to say. I know what a 50 and a 200 are going to say. As Big Eb says, Big Eb posted in the chat here, says the 20, 50, and 200 are popular and can move markets when broken. Absolutely. I'm looking for the self-fulfilling prophecy. Now, and I don't want to sound like a jerk. I know that Brandon uses a very bizarre combination of moving averages, a longer term and a very short term one. And I'm not saying it doesn't work. It just doesn't. It's not for me. Now, we'll look at a crossover system here in just a second. Yes, Jeff, it's definitely way different. One is a smooth, charismatic, highly intelligent African-American male in Dr. Woody Johnson, and the other is just a total doofus white guy who I don't even think he has any medical doctor credentials in Dr. Woody. I mean, I don't know. I could be wrong, but they call him Dr. Woody. That's what the name was, and maybe because he was such a surgeon of the financial markets, but they're very different people. Speaking of which, I need to get our Dr. Woody Johnson back on the show. So, you look at this type of stuff, I don't need to put these moving averages on there, but as Big Eb points out, rightfully so, is for a lot of these, it's self-fulfilling prophecy. So, I did it's a horrible analogy, at one of the trade shows, and it's knowing about human emotions, behavioral actions, and responses. And I was standing on front of stage, I think this was either Las Vegas or New York, and I said, fear is a much stronger motivator than greed. We just know that from a psychological experiences. And the one lady said, well, could you give us an example? And I said, okay, I'll give you an example. Let's go to the greed side. I said, guys, I've got a $20 bill on the table up here. First one that gets it can have it. And they kind of looked around, and one lady gets up to start to come and get it. I said, too late, you took too long, you don't get it. But it was, took a while for people to go, oh, yes, I'll go for it. And then I said, guys, I've got a 45 caliber handgun in my back of my pocket. And I said, I don't, I'm just kidding, because I would be crazy and I'd create a panic. But if I pulled out a handgun right now, what's that reaction going to be like in this room? And everyone's like, yeah, I'm running for the doors, I'm freaking out. Fear is a way bigger motivator than greed. So if we can start to line up moving averages, the 20, the 50, the 200, the common stuff, and know that where that fear or greed is going to start to take effect. If something breaks below a 20-period moving average, it's not that big of a deal. If something breaks below a 50, it starts to become a bigger deal because 50 is a pretty powerful, stronger indication, right? It has more time, more data. Bob Dunn would tell you, the longer time frame you look at, the better. Well, moving averages help you with that. Same thing with the length and time of your moving average. Now, if you go to, let's say, a 200-period moving average, and let's just show you some charts here. Let's see. It won't let me do all of them. And by the way, let me just show you on this one. This is the S&P. Here is what a simple moving average looks like. Notice it's got slight little chops to it, but it's still pretty smooth. And if I add the exponential, you can see it's much more responsive. They're different colors. So let me see if I can change the color and make one of them red so we can very clearly see the difference in this. I'm hoping that this is red, and I'll make the lines a little bigger for you guys. Hopefully that helps. And we go okay. And then let's make this one look the same size-wise, and we'll make that there. Okay. So here you can see the red line is your exponential, and you notice that when this thing had this big up move here about a month ago, the red line, the exponential moving average, hooked much quicker, much sooner, because it's using the most recent data, and this big candle right here all of a sudden pulls it up very quickly. So this is, from a shorter term intraday perspective, I would prefer to be using the exponential. You could make the argument that, well, it would have gotten me in a little bit sooner on this turn. Yes, it could have. Now, when you look at things like, let's say the 200 period moving average, which to me is the granddaddy, right? This is one that I had a lot of respect for when I was studying the financial markets, because I read through some mutual fund prospectuses. And these mutual fund prospectuses, not all of them, but I'm curious as to how these things are constructed. And one of the things in there says they're not allowed, and this is for the specific ones, I think it was Neuberger Berman funds or something like that. The one exactly, Eric. We had this thing about the charts yesterday, and I was like, I don't like watermarks because they make it messy, but it does help people see what it is. So most people said they like the watermarks. Therefore, we're a democracy. We'll keep them there. Shit, and I completely forgot what I was talking about. Oh, that's unfortunate the way that happened. I was talking about the moving average. I got 200 period moving average. Oh, in the prospectus for these Neuberger Berman mutual funds, it said that they are not allowed to hold positions that are below their 200 period moving average. And I was like, holy cow. So you're telling me that you have in your prospectus given yourself legally binding rules where you say we can't hold shares in this ETF or mutual fund if those shares are below their 200 period moving average. So right away, that tells me if I'm sitting here trading and I see something that might be coming close to its moving average. Let's see what right now is getting near. It's probably below its 200 period moving average. Let's see. Off the top of my head, something that looks really Walmart. Walmart's a great example with their earnings today. So here's Walmart. And it's not below its 200 period moving average, right? But it's ripping down today. It came flying down. And if you look at where it's at, it's still a buy. Although look at the 200 period moving average. This tells you that over the last 200 periods, Walmart's really just done nothing but gone sideways, right? It's really since May of this year, it's been, even though it's had big swings, it's pretty sideways. Now you look at the 20 period moving average. This is an exponential, by the way. Much more responsive to price, and you can see you could get a lot more buy and sell signals that way. The point I was getting at is, let's say Walmart was in one of these mutual funds that I was checking the syllabus out about, or prospectus. That means that if it closed below the 200 period moving average, and it was on a weekly, by the way, so weekly, that's an important distinction to make, they would be forced to liquidate these positions. Now you talk about self-fulfilling prophecy, where I can look at an institution and know that they can't hold this. They could literally be sued by the investors of that mutual fund if they held Walmart, or in whatever case that security was, that closed below its 200 period moving average. So to me, that's where I kind of gained this respect for the 200. It is like the big daddy out there. I don't know if a lot of mutual funds are telegraphing their portfolio like that and limiting themselves by saying we have to sell if it gets below a 200 period moving average. But I thought it was interesting, at least for me and my understanding of how moving averages should be used. Now, how many of you guys, some of you guys know, what is Brandon's combo? You guys, a lot of you guys know Brandon Wendell. He uses a specific moving average combo. I forget the numbers. It's like an 888 or something like that. 988, 388, something. Somebody knows it here. If you tell me, I'll put it on the screen here, and we'll I'll show you kind of what that looks like. Now, the question is, how do you use them, right? For me, moving averages are real simple, at least the way that I use them. I am using them just to, 889. Thanks, Kenny. So let me add in another moving average here. We'll go to moving average, and we'll add on another one. So we'll keep these as simples, and I'm going to add on an 8, and we'll add on an 89. So you got a much longer term moving average and a shorter term moving average. All right. So the main gripe I have against this type of system, and this is nothing against Brandon's, because I'm not going to go into really his strategy, which is definitely much more of convergence divergence, right? Positive divergences or negative divergences, which I actually do think highly of that type of trading strategy, where things are getting stronger, weaker relatively. if you look at a system like this here I have in blue is your 8-period moving average, and in red, or sorry, yes, blue is your 8, and then your red is the 89 period. So you're going longer term versus shorter term. It's really something to say as a trigger to keep yourself in big trades. So the mistake that a lot of people make with this is when they have a moving average crossover system. What the system is basically telling you when you use something like this is when the shorter term crosses below longer term, which is right here. On Walmart, that would be on the 27th of September of this year, was the most recent time that the blue crossed below the red. On a crossover system, a lot of times that's the signal to where you should be getting out or going short. And my attitude is, if it told you to get out here at $142, there was more clear signals much higher up. Like I'd have been out at about 146. I'd have gotten out at least $4 earlier as this thing started to make a new low if I was long. So the point I want to make there is when you're using these, I would say using them incorrectly, which is using them as a crossover, that you are late to the party. Notice when it gave you the buy signal. Now a lot of people look at the cross right here that happened on October 22nd and say, oh, okay, the blue crossed the red at $143. That's right where my cursor is. Well, no, you could not buy at $143. It's impossible. It wasn't trading at $143. When these two moving averages crossed on the 22nd of October, price was trading up here at 148, right? So these are very lagging if you're using, especially when you're using something so big like an 8 and an 89. That's a big spread between the two. Now, as you see Mike LaRusso put in the chat, you have an 8 and a 13. Well, that's very doable. But now what you've done is you've given yourself hundreds of signals. So if you use an 8 and a 13, again, both fib numbers, you're usually, unless you have a real strong trend, and conveniently we're actually on something that was trending beautifully. I mean, look at the 5 distinct trends here, or 4 distinct trends. Huge move up, huge move down, huge move up, and now we're in a huge move down. Those 4 gorgeous trading opportunities. Great trading using these moving averages. But we could look at some other stuff that might be, a little more choppy. How about, right? So this is AMC. It's giving you crossover signals. And yes, it gave you a most recent buy signal right here. And you're going, yeah, that's great. Well, the buy signal would have happened right here on the close, which means 41.74. So yes, you'd be slightly up right now, just barely. Better buying it now. Well, Eric says Tick uses 13 and 30. Look, a lot of there's so many different combinations, and it doesn't matter whether you use an 8 and 89, whether you use an 8 and 13, a 13 and 30. Doesn't really matter to me. I just want you to understand that if you see these crosses, like right here, oh, this is a good one on AMC. It's saying get out of your long positions or go short. Right here where they crossed, right? And the cross is at 46.04. But the actual trading price was at $39, $38.80. So a lot of times they're way off. And this is what a lot of these red light, green light systems will do, is they're pretending that you would have gotten out at $46 when in reality, that's impossible. It's not trading there. It's trading at $38.80, right? So whatever we do decide to change these, the shorter term you get, the more likely you're going to get a lot more buy and sell signals, right? So if you use bigger time frames, let's say you use a 20 and a 50, well, you're going to be very late to the party, but you're going to get a lot fewer signals. If you use an 8 and a 13, you're usually going to have a lot more signals, and you probably won't be staying in a lot of strong trends, right? A lot of chop, a lot of false signals. Day traders use volume weighted average price. Yeah, and maybe down the road I'll do another section on volume weighted average price. I want to get to a couple listener questions here. The best way to use these types of systems is just, at least from my perspective, again, I like to keep them at 20. So I'll go to 20, not a 1320. 20 period and a 50. And if I'm really curious what the big long-term picture is, I'll look at the 200. But honestly, I'm not that concerned with them. Tom says, as we look at moving averages, the supply and demand zones are clearing their throats, trying to get my attention. How do we use averages with zones? Good question. So if you have a priority, like a hierarchy of needs, was it Pavlov's hierarchy of needs or something like that? Maslow, something. For me, number one is the price action, right? What is price doing? What does the chart look like? That means supply and demand zones are the apex of that selection criteria. If I find moving averages are trending down, or maybe they just started to curl back up and that's in a demand zone, that just further bolsters my decision to go long at that point. So for me personally, the only real way that I use them is just to be my decision support, to say, okay, you're in something long right now. Great. Now, my main rule for going long, or it being in something long, is it's got to be making higher highs and higher lows. I need to be seeing that trend line moving up. And as Margaret says, what about old-fashioned trend lines? Trend lines are subjective because every one of us is a different artist. If I gave every one of you a pen and said, draw a price chart, there's no way that any two of us are going to have the same picture, right? It's not going to happen. If I said everybody put a 20-period simple moving average on your price chart, we're all going to have the identical picture. That's the reason why I'm not a huge fan of trend lines. I think moving averages allow everyone to see the same thing. Do I draw trend lines? Yeah, you guys see me do it all the time, right? But I don't put a lot of, I guess, emphasis or reliability on the trend line itself. Moving averages, a bit more so reliability for me because they're algorithmic. If I ask an algo system to draw a trend line, it might draw it way different. If I say algo, computer or system, if it breaks its 20-period moving average, get out. Well, I can see that. I'll know what it looks like. So to me, I'd rather use moving averages in that sense. But if I'm in something long, and to go back to Tom's part here, my hierarchy says, boom, I saw a nice demand zone. All right, I bought it long. Great. Now, once it starts to move up, what are the criteria, the decision factors that's going to keep me in that specific trade? Well, is it making higher highs? Is it making higher lows? Maybe I'll move my stop losses up below those most recent lows. But moving averages kind of helps you visually look at that and say, okay, it's trending up. I mean, look, let's look at NES and look at the NASDAQ, which really ripped up today, almost got into a double top situation. Both of these moving averages are saying, hey, you know what? Stay long. There's no reason to get out here on the NASDAQ, even though it's unbelievable, it's ridiculous, it's completely manipulated. Who cares? It doesn't matter. Price chart saying it's going up. Moving averages, maybe a little too steep here. I personally think this is too steep of a rally, but it is doing what it's doing. So until it gets below, let's say, a moving average or starts to make a new low, then I will just be bullish and stay long. I hate to admit it. Now, to Tom's point, said, well, what about trend lines? And how do you deal with that demand zones? Well, if you notice right here, you had initially this nice move up on the NASDAQ, and November 1st, there was like this little hesitation, then it ripped up to this most recent move, and then it retested. So if we just put a line on the NQs, NASDAQ 100 futures, right around 15,901, to me, that's an interesting point, because if all of a sudden we get a sell-off over the next couple days and it comes right down to its 20-period moving average or that horizontal line, I'm thinking there's most likely going to be a bounce back up. But what happens if all of a sudden we fall back down, we're now below the 20-period moving average, and then we break this 15,901? Now all of a sudden I have multiple reasons to help my feeling or my position that this market may head down further, because now all of a sudden we're down below a 20-period moving average, we're down below most recent, we're making a new low, and I can start to not maybe formulate this opinion that we're going to have a market crash and it's all going to go to hell in a handbasket, but maybe the up move is a little bit overdone, right? Normally, and I've done this one with you before, where if you have a rubber band, you put that around your wrist, and that elasticity to price is important. The further away that those moving averages get from price, the more likely it's going to come snapping back down. And in this case here, you can see that the moving averages has been accelerating aggressively. Price was ripping. I mean, this is such a rare move, in my opinion. Going back to my 20 plus years of trading, you don't see too many moves like this where it seems like every single day you made a new all-time high. I mean, it was just ripping and ripping and ripping, just didn't want to stop. That usually will come to an end. And you can see how here on the 5th of November, that was the most extended we were above that 20-period moving average. So we corrected. I actually thought we'd come down a little bit further. I actually had the 20-period on. I was expecting that as a price point. I really wanted to get down here lower to about 15,550, which is where we had this last little kind of real rip up. But right now, until we make some new lows, until we get below moving averages, right, I'll just have to bite my tongue and stay long these markets. The averages might give a clue what the supply zones may be broken, and yes, on moving average stops. Yeah, just remember, if you're using a moving average, you're late. I don't care what time. You could use a 1-period moving average. Well, that's just trading the most recent bar of data. So if you're using moving averages for your buy and sell signals, you're late. You almost never are going to be anticipatory unless you're using something like, Brandon uses, and many others use convergence and divergence. Sorry, the COVID fog is still there. Convergence and divergence on price charts where, the moving averages are drifting down, but the market is still going up. Well, that's a negative divergence there. You can have positive divergences, negative, and that gives you a little bit of a clue that something is awry, and one of them is going to come back and pull back the other way. All right. So Lee, that's hopefully I answered your questions for two things. Number one was, what is my preferred period for moving averages to use? There's three of them. I have the 20, I have the 50, and I have the 200. Those are the three main ones that I look at. Then to Karen's question, which is what's the best way to use moving averages? In my opinion, and this is solely my opinion, it is to be using them as a decision support tool to keep you in a trade as long as possible, right? And I think the 20 is great for that. If you're a strategic investor kind of guy and you want to look at the long-term picture with weeklies and monthlies, well, maybe you look at the daily, but keep it on a 50-period moving average, or go to a weekly chart and keep on those 20s. It's just the bigger picture there. All right, so let me see. I think I got most of that covered. RSI, Margaret says, RSI is more of an oscillator, not a trend tool per se. I think I talked about that one in the past, but I'm more than happy. Maybe we'll do another show on different indicators because there's so many of them, and a lot of people have questions on what are the different indicators, how to use them, etc. Okay, let's see. I had to go back here because I wanted to talk about this today. I talked about this on the Monday Morning Must Knows. If you guys saw that one that came out from OTA on, I think that was Sunday night, Monday morning. Very interesting thing happened with retail sales. If we look at the historical data, the past 5 months, they have been forecasting a contraction in the retail sales number. Now, this is simply a tactic. It's an absolute strategy to do to get people thinking positively. And here's what happens. They say, oh, we're expecting a negative 0.1 in retail sales number, meaning contraction in retail sales. And they know it's going to be higher than that, but they'll say it's a low number because what they want to have happen is all of a sudden the markets go, wow, we came out at positive 0.1, which in the grand scheme of things means we're barely growing with retail sales. But the market views this as astronomical because we're expecting negative 0.1. So this is just kind of behavioral psychology, market manipulation going on from the data providers. So here's what we had today was a retail sales number that was way better than expected. Yes, Boss Poopa, I know. I try to stay away from the politics side, but the more that I've interviewed people in the industry who are on the data side and understanding politics a little bit better, it just makes me just not believe all this stuff, this data. So look at the retail sales numbers. They are expecting retail sales to jump from 0.8% to 1.3%. So I'm pretty sure they knew it was going to be higher than that. This was designed to say, hey, things are looking good, markets are great, let's go shopping. And we came out at 1.7, which was significantly better than the retail sales number expectations. And of course, what do we see today in the markets? Well, I think we all saw what happened out there today. NASDAQ up to the tune of about 0.66%. S&P pretty good, teetering on all-time highs at 4,696.50, up about 0.37%. You had your Dow was up, you had your Russell was barely up. Russell, almost unchanged on the day, but it was a well-received information. Now, What's interesting is I got a nice email from Mike, and thank you, Mike, for that email. And I think, actually, one more thing here. There was Walmart reported earnings today, and right now they're down about 3%. You can see we saw that chart earlier. It's a pretty aggressive jump down in Walmart, even though they beat earnings by 6 cents. They're supposed to come out at 139. They came out at 145. Great. Good job for Walmart. They just paid a price today. I mean, it was not a good-looking day for Walmart, and I'll bring up that chart. You already looked at it. Right, so there's Walmart. Let me get rid of these moving averages because I think they just clogged the chart up. But, right now, Walmart not looking so great, even though we had great retail sales numbers. So, yeah, Margaret, it did not help Walmart. And I want to kind of spend some time this evening. Not unfortunately, but I have a lot to do with my crypto program this evening, so I may not get as much analysis done as I want. But I'd like to kind of dig into what Walmart was citing because what was the problem? Because I'm pretty sure a bulk of this was based off of what happened at the shareholder meeting afterwards, right? What did they see? And I'm pretty sure that they're going to cite supply chain disruptions and China and shipping and all that and increased costs. I think that that's going to be a big part. Maybe the profit margins slipped a little bit because of that. But I think that that's the main reason why you saw them dip down today. May actually create a good buying opportunity. So there was some questions that came in related to that topic. Let me make sure I get my screens all right here. Yeah, and this is from Mike. So let me bring up my PowerPoint again. So many things to do. So there is the PowerPoint and that one. Mike says, I saw this on Fox and I cannot imagine that there is anything but a green light to buy any retail stock. Maybe even Best Buy and a chance to get that $100,000 back. He's being sarcastic because he knows I won't trade Best Buy because that one hurt. That one stung me pretty bad. It looks to me like people are ready, willing, able, and anxious to spend. What are your top 3 retail stocks to buy? Well, there's that chart again. You can see year over year, 16.3% growth, month over month, 1.7. Those are pretty significant jumps. And, I don't know historically what kind of is the record for year over year, but it's got to be pretty close with 16.3%. That's a pretty aggressive spending, which of course drives inflation prices potentially even higher. So what are my favorite 3? I don't really like retailers personally. If I was to go and pick 3 retailers, I would probably pick one that you mentioned, Best Buy. Best Buy always seems to do well in the holidays. Number 1 would be Amazon. Number 2 would be Walmart, and number 3 would be Best Buy. And you're like, oh God, why those big names? It's precisely for that reason. They're the big, most stable names out there. And if you look at the charts, that might sway my decision a little bit, right? So we'll start things off with AMZN. Amazon's not looking great, although I do like the fact that it seems to have stabilized, right? I'd like to see it kind of make some new highs here, but it's really been a boring year. If you go back to last August, it has been a very boring year for Amazon. For anybody who's a shareholder of it, it has not done that much. I still think they're the greatest company in the world, and I think Jeff Bezos will continue to steer it down that path. But from a retail sales perspective, yeah, Amazon's the king. Walmart. I'm not thinking about buying Walmart right now, but you know what? I think it's going to get to some points here soon. I mean, if you look down around this 140 mark, that to me is a pretty good buy point. And we almost closed that gap that we established back in October. On the 18th of October, we had a pretty nice jump up in Walmart. This pullback could create a buying opportunity. Long term, I think Walmart's going to do fine. It has a similar picture to Amazon where the retail sales just have been struggling for a while, and maybe this is the reflection of some of those supply chain disruptions. But this big sell-off here in Walmart, I think, gives opportunity. I'm pretty sure that Walmart's not going to disappear and fade and go under like, somebody like Macy's, right? Macy's, even though the chart looks absolutely amazing, if I have to look long-term, I got to go with a Walmart instead of a Macy's. I mean, this chart, we looked at this a couple months back. It's just unbelievable how strong Macy's has been lately. It's just phenomenal. Still not one of my top retailers. Eric says Shopify. Are you saying Shopify or you want to go shopping? Shopify is an interesting one. I don't know if I would call this necessarily retailers. It's kind of a weird situation with what they do. I mean, it allows people to set up their own individual storefronts and businesses. Certainly, I think that's a very positive business to be in. I like the retail somebody's physically selling products and services from a centralized entity as opposed to a bunch of small fragmented businesses. This creates unpredictability for me, whereas something like an Amazon, a Walmart, or a Best Buy, you get, I believe personally, you get much greater transparency and you can see what each one of those guys is doing. Let's see what else we have. Yeah, and by the way, Target reports earnings tomorrow morning. Yeah, both of them are great. I would much rather go shopping at Target than a Walmart, that's for sure. There's some really funny stuff if you ever want to bore yourself. Go to the internet and you can just type in, like, I think it's called People of Walmart. Oh my goodness. Walmart has earned themselves a very interesting reputation there with regards to their clientele. But if you look at the chart, Target looks way better than Walmart right now, and just about breaking all-time highs. So, yeah. I think yesterday we actually had a comment from a viewer asking about shorting Walmart, and I still maintain you got to wait for it to break those lows we established yesterday. So, unless it gets below 261.43, stay long. It's tough to short going into holiday, and I personally am not going to short anything going into the holidays. Yeah, I don't know what it is. It's like the different clientele. Boss Poopa says Target people are not as funny as Walmart people. I think Walmart, sometimes you see the people that go into Walmart, it's almost like I think they're just waiting for someone to take their picture and post them on these sites. Like some of the stuff they wear is like, wow, how could you wear that stuff? It's nuts. All right, let me see. I think I had one other question here, and it's getting late, so I got to wrap up because I need to get ready for my crypto program this evening. What else did I have? No, I think I got everything I needed to get done. Best way for moving averages. Yep. All right, so let me just go through economic calendar announcements for the 17th, for tomorrow, which there's some good stuff tomorrow, I'll be honest. Let's start things off with the economic calendar for the 17th. As you can see, we have final CPI numbers coming out for the European Union, which is expected to stay the same. They're not forecasting any changes there. That's at the top of your screen. Canada has a bunch of CPI data as well. They're expecting a sharp increase. You can see it's gone from 0.2%. Expectations are they're going to come out at 0.7%. So Canada also potentially experiencing a pop in consumer price index numbers. And then down for the U.S., you can see down here we have at 5:30 Pacific time, so 1 hour before the markets open, we have a couple of announcements that deal with housing. You've got building permits and housing starts both coming out at the same time. And then there's this one, and maybe I can even throw some graphics since I paid for the guy to build these for me. We've got our popcorn trade of the day. Yes, popcorn. See, so much fun. I love popcorn, by the way. I might even have a nice bowl of it tonight as I watch a movie. The popcorn trade of the day is going to be NVIDIA. Now, for those that don't know, popcorn trade of the day means you put your chart on a 1 minute time frame. You show 24 hours so you can see the after hours time frame. You put your feet up on your desk with a bowl of Orville Redenbacher popcorn, and you just watch the fun happen and watch that market just bounce all over the place because it's going to be a wild one. And the reason is, if you look at the share price of NVIDIA, which I will share with you right now, let's go to NVDA. All right, you're at $302. And this is after splits, guys. This is after a split. We split, I think, what was the split? 2-1? 4-1. They already split 4-1 back in June of this year. June 20th of 2021, they did a 4-for-1 split, and it's already almost doubled its share price since then. $302 right now, so this will be a wild one. It's having a small moment of hesitation, but boy, ripping all over the place. A little bit of a pullback now. We'll see if it can get down. I mean, there's some unfilled gaps here that you can see. There's an unfilled gap at 266, an unfilled gap down around 230. Those could potentially fill, which is why it's a popcorn trade of the day. Leave it alone. Could be very, 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 very volatile. GD, what happened in crypto? As Big Eb says, gets you a buying opportunity out there. You guys can see across the board here. I will sort, and let me just sort that. Litecoin, it's so funny. I have this blue line on here. This was where I was planning on selling. I didn't sell. I mean, it literally went a couple cents past my target and has been falling ever since. Son of a biscuit! But yeah, a lot of this is just based off of what's going on over in China. And I think a lot of it has to do with some major upgrades happen to networks, and it's a case of buy the rumor, sell the news. But we'll talk more. Unfortunately, I won't be doing that in here, but in the other class this evening, I will be doing a much deeper dive into the cause and effects of all this stuff. I think, as Big Eb does, it just presents a buying opportunity. And I think I actually bought some more today. I bought some Chainlink. I bought some Ethereum. I bought some Bitcoin. I bought some more Polkadot, and I have some orders out for some other cryptocurrencies as well. But just a buying opportunity on the big picture. All right. Chowsky wants to look at HUT. All right, just because. Well, all right. So let's just look at HUT real quick. So HUT 8 mining. All in all, Chowsky is one of the better ones that you brought to us. You like some really wild, crazy, high-flying stuff. If you look at this price chart, I think it looks great. HUT 8 mining, I think you're getting that situation where it's pulling back and find a nice demand zone where this where you want to buy into this one. But doesn't matter which moving average you're going to use here. It's trending strong. It looks good. It just seems like it's going to have a pullback here and then more rally back to the upside. So HUT 8 mining looking great. Good one, Chowsky. ATRs are higher on crypto. Yes. The average true range are generally going to be higher on those because of just the sheer volatility. I mean, you look at today's price action. You had gold up 0.78, gold down 0.78, crude oil down 0.37, Russell up 0.16. These little tiny moves. And then you look at the crypto stuff, it's like down 10%, 8%, 5%. It's very, very volatile. So those ATRs are definitely going to be higher. All right. I think it's going to do it. So let's see. If you guys enjoyed today's show, I enjoyed it. I always love talking with you guys. Do me a favor. You can obviously click the like button if you're watching the Facebook or YouTube feed. If you have questions, something you want me to cover on tomorrow's show, send them on in. Today's topic was driven by viewers and you guys sending in your questions. So for those that did, including Mike, and then of course we had Karen and Lee asking about moving averages. Let me know what you want to talk about. I'll see if I can build a program around it if I have some time. So send them on in at TraderMerlin@gmail.com. Until then, happy trading, everybody. I'm going to get ready for another class. I'll see you tomorrow.